There's just a little bit of consumer weakness out there this morning. Live from New York City. Good morning, good morning. Equity futures just about positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Walmart delivering a cautious outlook as Fed officials refuse to declare victory, and Biden and Xi's meeting delivers small wins. We begin with the big issue, retailers facing slowdown fears.
There has been a little bit of bite that we have seen on the consumer.
Seeing those cracks in the consumer show up more readily.
When we look at retail sales from a real perspective, adjusted for inflation, volumes are still declining.
When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly.
Retailers certainly need higher volume to kind of get to the numbers that they want.
If we look back at Q3 earnings guidance from a number of companies,
the consumer is tapped.
Their wallet is very much under pressure.
A key trend that came through was the fact that consumers are under increasing pressure.
The American consumer does have the propensity to spend.
Continues to spend.
When consumers have jobs, they will continue to spend.
The labor market is the catalyst for it.
Will this holiday season be a source of upside surprise or a downside surprise when it comes to consumer spending?
The real question is are we going to have a slowdown?
It's all about the consumer.
It's all about the consumer this morning. Joining us now to discuss this, Nuveen's Tony Rodriguez, Mike Contopoulos of RB Advisors. Gents, we've got to start with Walmart. It's down by about 6% in the pre-market. This quote from the CEO on the earnings call, this line here, we may be managing through a period of deflation in months to come. Tony, how do you respond to that one this morning?
Well, good morning, Jonathan. Good to be with you. I certainly don't expect we're going to be in an environment of deflation. I understand that from a perspective of the largest retailer in the country, they are certainly looking at the next couple of quarters, and there's some pretty significant headwinds from our perspective in terms of consumer spending. And we think that kind of the segment of the market that Walmart is strongest in, some of the lower income areas, those consumers are going to be the most stressed. So not surprised to see Walmart talk about some cautious outlooks ahead, but certainly the word deflation is not something that's in our lexicon as we look at the next couple of quarters for the U.S. economy writ large.
Tony, is it across all income groups? It wasn't just Walmart this morning with a bit of a warning going into the end of the year. Burberry with some dreadful numbers in London. That's a luxury player. That stock's getting hammered. Is it across all income groups?
I do think it's across all income groups. The lower income groups are probably the most supported by the very strong labor market, and we're starting to see a little bit of a softening in that. I'd still call it solid. It's just not red hot anymore. So it is across all income groups, and it's going to be a relatively slow playing phenomenon. We don't expect to see the consumer fall off a cliff, but we do think these headwinds of not only the higher prices they're facing because of inflation, but now, student loan payments are hitting, higher cost of financing for a variety of durable goods are hitting, and we do see this softening in the labor market. So that combination is really going to affect consumers across all income spectrums. But again, we're not expecting it to fall off a cliff. We think it'll moderate slowly over the next couple of quarters.
Let's talk about that cliff. Mike, you've said for a while, stronger growth now means a harder landing later. Is that still the case for you?
Yeah, I think that's absolutely the case, Jonathan. The question is just when is that harder landing ultimately going to materialize? I just don't think this cycle is that different than past cycles. And if you actually think about it and you look back at the data, it's kind of played out exactly as you would have expected. I mean, we had a lot of weaker economic data earlier this year, and then around summertime, it started to reaccelerate again. And we're in that reacceleration phase at the moment. Now, that doesn't mean, we're off to the races. We're going to be at 6% or 7% GDP growth, but nominal GDP growth is still quite strong. The labor market, with an unemployment rate of only 3.9%, suggests that the consumer is still somewhat healthy. And so I think before you get that next downturn, which will likely be a deeper downturn, you still have some runway here for growth. So I don't think this is an imminent sort of recessionary scenario that we're living in. But when it happens, yeah, I absolutely think it's going to happen just like past cycles, and it's going to be pretty deep and hard. But that might not be till the second half of next year or even 2025 at this point.
Well, that's what equity bulls are hoping for. Michael, I'm just looking at some of the moves this week. Buying discretionary real estate, the equity market absolutely surging after that small downside surprise on CPI on Tuesday. Are you ultimately saying, though, Mike, that the dream of painless disinflation is one you should think about selling in 2024?
Yeah, well, I mean, listen, I think, that might actually be the case. I mean, we're pretty constructive on equities, particularly cyclicality, whether that be energy or industrials or small caps. But we're also cautious when it comes to credit. I think we're living in a late cycle economic environment and maybe an early to mid cycle profit environment. And that makes things tricky here. But the whole, immaculate disinflation story, I think, is a far stretch. I mean, either we're going to have stronger than expected growth or we're going to have a hard landing. In RBA, we think it's the latter first, stronger than expected growth for maybe the next 3, 6, 9 months, followed by some sort of traditional recessionary scenario. And that typically means you have to be a bit more nimble, a bit more tactical, and a bit more open-minded as the data comes in and suggests, how you want to be positioned.
Tony, are you on the same page?
I would say we're not entirely on the same page in terms of we do think that there's a reasonable probability that a soft landing or a milder recession is actually what we see kind of in the middle to second half of next year as opposed to the hard landing. Certainly the risks are there for a hard landing, but we think that there's, certainly a pretty sizable chance that we avoid a hard landing. We're not expecting reacceleration. So we do think we'll see positive growth next year, but we think it's going to continue to moderate. So the story there is that, consistent maybe with Mike is saying, we're very, cautious on very, very low quality credit, for example, the CCC space, the very low single B space across asset classes. But when we look at higher quality below investment grade assets, there we think we have company we can find that are going to be resilient from a cash flow perspective, interest coverage perspective, and attractive total return perspective for clients. So those areas of the credit market we are comfortable shopping in, but we are cautious on the lowest quality segments.
That's the credit market. Let's look at equities. Equity futures just about unchanged going into the opening bell, about 25 minutes away. Tons of economic data this week. CPI on Tuesday, retail sales yesterday, this morning, jobless claims. Mike McKee, jobless claims just starting to inch a little bit higher.
Just starting to inch a little bit higher, suggesting maybe the labor market is loosening up as the Fed expects. But we're also in that period when it's hard to get a clean read on claims because of holidays. But they do rise by 13,000 over the last week to 231,000. And perhaps more important for some analysts, 1,865,000 continuing claims compared to 1,833,000 the week before. Immaculate disinflation, though, take a look at what we got from import prices, down 0.8%. We're now negative 2% for the past year. Without oil in there, it was down 0.2%. So we're still seeing a decline in what we're buying from overseas. A little bit better news from the Philadelphia Fed, but not great. However, their prices paid index does go further down to 14.8 from 23.1. It's the claims and continuing claims that people are watching because they want to know if we're going to see higher unemployment. And it is certainly possible. Continuing claims have now reached the highest in a year. The question is, if we get a rise in unemployment, does it keep going or not? And that's going to be the question for the markets ahead. Right now, the markets are, and I'm going to quote a British policymaker who said today, they're not clocking on to what the central banks around the world are trying to say. Take a look at where we are with Fed funds futures. We've priced out, zero, literally zero now for the next 2 Fed meetings. Maybe we don't need to show up. And then the first rate increase in June, but we're also getting a little bit closer to that in May. So we'll see how the data keep unfolding and whether the markets put more pressure on the Fed. And I guess, John, it'll depend on whether or not we do see unemployment go up and inflation continue to drop.
Precisely. Mike McKee, thank you, sir. 2 points there, the economic data and what it means for policy. Tony, let's go to the economic data. This is what Mike Kontopoulos and I were talking about just a moment ago. The dream of painless disinflation. Tony, is it just that? We've had the disinflation. Is the pain just around the corner, specifically in the labour market?
Yeah, well, we definitely don't think you'll see painless disinflation, but we do think inflation will continue to decline, and we do think unemployment is going to continue to rise. I think the big key is, do you see unemployment rise into the 4 to 4.5% area, and that's where it peaks out, or does it continue through that level up to what is a more traditional rise in the unemployment rate in a slowdown / recessionary environment, which is at least 2 percentage points. So we're talking about 5.5%. We do think that there are some conditions in this current cycle that might indicate that employers are going to be a little bit more reluctant to let go of labor, given the recent issues they've had with trying to hire back a skilled labor force. So in our view, we might get to around a 4.5% level. That's consistent with this slowdown that we're expecting in the economy, the ability for the Fed in the second half of next year to pivot to maybe cutting rates, probably not as aggressively as the market is currently pricing in, because we don't believe in this immaculate disinflation. But we do think we're going to continue to move lower on inflation, higher on unemployment, and slower on economic growth over the next couple of quarters.
And Tony, what you just said, though, is really important. We've got equity bulls this week really bulled up on the idea that this Fed can reduce interest rates sometime soon. Why the second half of 2024 for you?
So it has to do with our belief that we're going to have stickier inflation. So the Fed, I think, is going to be very focused on trying to keep the real Fed funds rate in restrictive territory, but not have it become more restrictive as inflation declines. So the more you think it'll be a rapid decline in inflation, the more flexibility the Fed will have to cut rates more aggressively. We think inflation will be a little stickier, won't come down quite as quickly, and that's going to allow the Fed to cut rates maybe 3 times in the second half of next year versus the 4 cuts that are currently being priced into the market. So we think the market's a little bit optimistic on the Fed's ability to respond in 24 with cuts.
This has been a big topic of conversation for us through the week. This market wants to declare victory over inflation. This Federal Reserve does not want to go there. San Francisco Fed President Mary Daly speaking to the Financial Times, to Colby Smith, saying this: we need to be thoughtful, need to take our time, not rush to judgment and not make any declarations. Mike Kontopoulos, are you in the same camp? If we get a reduction of interest rates, when is it going to land?
Well, I'm not entirely convinced we're going to see a reduction in interest rates anytime soon. I think it's too hard to sort of forecast, in the back half of next year. We just don't know what's going to happen between now and then. I mean, I think for every reason to expect lower inflation that we've gotten more recently, you can come up with a different reason to expect higher inflation. And of course, there's been a number of head fakes over the last year. So I'm not prepared to make a call on when the Fed is necessarily going to cut interest rates. But where I'll disagree a little bit with Tony on is that because of the sort of structural labor shortage that we're seeing, I think it's going to be very difficult to get to 2% inflation with an unemployment rate that only goes to 4.5% as an example, which you would kind of classify as a very soft recession, which I would agree with. I just don't think you can get to 2% with another 60 basis point rise in unemployment, particularly if you're drawing people back into the workforce. And that's sort of where we sit. It's that in order to really get to the Fed's mandate, you almost have to bring the unemployment rate north of 5%, which by definition then implies the hard landing. The problem is that might be much later than what most market participants expect. And so not really prepared to make a call on when the Fed's cutting, but my guess is it's going to be later than the market expects rather than earlier.
So, Mike, I hear 2 calls from you, one more near term and then one out in the future. I'm not sure where it lands, but ultimately the near term sticky inflation converging maybe towards 3 to 4% on CPI and not down to 2. And then further down the road, there's got to be some kind of economic reckoning to get inflation down back towards target. With that in mind, Mike, if you've got a bond market cool right now, does that mean, in the near term at least, there are limits to how far this bond market move can go?
Yeah, I think there is. I think we're going to be very range bound, Jonathan. I mean, I could see 4% on the 10-year, and I could see us back up at 5% on the 10-year. And so, our view is that it's just not the time to take a lot of interest rate risk here. There's not a tremendous amount of downside, but there's also not a tremendous amount of upside. So you might as well try to find your opportunity elsewhere. And the good thing is unlike in the beginning of the year where kind of cash was king and that was the obvious place to be, there are other opportunities, whether that be through curve trades, whether that be through things like preferred securities, whether it be through AAA CLOs or agency mortgage-backed debt. I mean, there are opportunities out there in fixed income where you don't need to take excessive interest rate risk at the moment to get a nice total return. And so given this uncertainty I've kind of laid out, especially on the timing, I think that's the way you're supposed to play and be much more neutral on the interest rate side.
We'll continue this conversation. Tony Rodriguez alongside Mike Contopoulos. Your equity market right now pulling back just about 0.1% on the S&P. Let's get you some movers going into the opening bell. Here's Abby.
John, beneath that relatively benign surface, we have some big name laggards, starting off with the shares of Walmart. They are down more than 6%, at least the last time I took a look. And yes, they still are. And they put up an inline quarter. They actually raised slightly, but it's the color, the composition. The company is saying that in late October, there was less demand. This is actually consistent with what Target said yesterday, that they are cautious on the near-term consumer, but investors not liking it from Walmart, which has produced so many good results this year and into today, up more than 15%. Palo Alto Networks, the cybersecurity company, their first quarter billing missed, and the guidance on the year for billings missed. That stock also down sharply. And then Cisco plunging down 11.1%, the biggest drop in about 18 months. Their quarterly outlook well short of analyst estimates. Investors clearly not liking that at all, John, with Cisco down 11%.
Abby, thank you. More from Abby around the opening bell in about 15 minutes' time. Coming up, President Biden and Xi attempt to play nice.
The United States will continue to compete vigorously with the PRC, but will manage that competition responsibly so it doesn't veer into conflict or accidental conflict.
Those attempts overshadowed by one single word. That word up next.
I believe they're some of the most constructive and productive discussions we've had. I've been meeting with President Xi since both of us were vice president over 10 years ago. Today, build on the groundwork related over the past several months of high-level diplomacy between our teams. We've made some important progress, I believe. The United States will continue to compete vigorously with the PRC, but will manage that competition responsibly so it doesn't veer into conflict or accidental conflict.
President Biden and President Xi playing nice, agreeing to restore high-level military ties, crack down on fentanyl and more. But much of the progress overshadowed by Biden's comments to the press.
And Mr. President, after today, would you still refer to President Xi as a dictator? This is a term that you used earlier this year.
Well, look, he is. I mean, he's a dictator in the sense that he is a guy who runs a country that is a communist country that is based on a form of government totally different than ours.
The Chinese Foreign Ministry calling Biden's remark, quote, extremely incorrect. Bloomberg's Anne-Marie joins us right now for more. AMH, we were playing nice, the pandas are coming back, and then that. Does that really change anything?
I don't think it does, Jonathan. Listen, President Biden has said this before, and he'll probably say it again, calling Xi Jinping a dictator. Obviously, it irked China, and they felt the need to respond to this. But then Xi Jinping went to a very warm welcoming and greeting amongst America's biggest executives, the titans of American business that he sat down with. And he said there he does not want China to be in a hot war or a cold war. He also says he does not want to unseat the United States. When it comes to the fact of the matter is, Jonathan, leading up to this meeting, we saw reports in the tea leaves of what the tiny, small deliverables would be, whether it be Boeing, whether it be fentanyl, whether getting back to that normal military-to-military communication that was really ripped apart when Speaker Pelosi went to Taiwan. But the main deliverable was that the leaders of the two biggest economies, Jonathan, sat down in San Francisco. And I don't think this comment, frankly, is going to overshadow any of those small deliverables, because the fact of the matter is, Biden has said this, and as we gear into the 2024 election, Jonathan, the rhetoric is about to get much hotter.
Without a doubt. AMH just taken down the heat in the last 24 hours, or at least attempted to. Anne-Marie, great work the last day or so on the West Coast in San Francisco. I want to revisit a quote from Peter Chi of Academy that we talked about in this program just yesterday, when he said, be prepared for the meeting this week to come across as highly conciliatory, prompting an everything rally into year end. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. Final thoughts now. Tony Rodriguez, Mike Contopoulos back with us. Tony, a lot of people talk about this cash on the sidelines on Wall Street, this cliche type stuff. Can we talk about the money in money market funds? Tons of it, Tony. What would it take to unlock that?
You know, Jonathan, probably one of the things it's going to take is FOMO, fear of missing out on the market. And when you look at the last couple of days, 2 weeks, that is a perfect example of how quickly the market can reverse. It seems like only 10 seconds ago we were at a 5% 10-year. Now we're in the 4.5%, just below area. The total return available there, if you look at a variety of fixed income asset classes, just month to date, you're talking about 2.5% to 3% returns, significantly outpacing cash. So we think that the opportunity that they may leave on the table by sitting in a money market fund is really quite high, as we're expecting to see a decline in interest rates, a slow, steady one through the middle of next year, where you're going to wake up, 10 years going to be sub 4%, and there's going to be some significantly stronger returns across multiple areas of fixed income than had you been sitting in cash. So I think as that realization comes through to clients out there, they will begin to put money to work. And in fact, some of the biggest risks have been moderated somewhat as the data has come in, not pointing to a Fed that has to re-accelerate tightening, but in fact can soon in the middle of next year pivot to cutting.
It's a really important question, Mike, because a lot of people sitting at home listening to this program right now are sitting in cash. They were told to. They got money for it. They got yield interest in a way that they didn't for a long, long time. What should they do now, Mike?
Yeah, Jonathan, I talk a lot with financial advisors and their clients, and these are some of the, believe it or not, the smartest investors that are out there. And they put their money in cash, and that's been actually the right trade for much of the last 2 years. And so I think kudos to them. And, I think we got to give them a lot of credit to understand when to extend duration, when to find, return in other products. And I think we're coming up on that point now. I mean, most folks are looking at the yields available out the curve and the total return potential in other products like agencies, as I mentioned earlier, preferred securities, and they're starting to get excited about it, particularly given that the equity market, ex-Mag 7, hasn't really done a whole lot for them. And so, I think we're nearing that point. Once the Fed does start to cut, whenever that is, obviously those cash yields are going to go away. That's where you're going to get the biggest movement to the rest of the fixed income market. But I think between now and that time, you're going to see a steady flow of money coming out of money market funds and preferred deposits and the like into more traditional fixed income.
There's a lot of money in those funds, that's for sure. Mike, thank you, sir.
Okay.
Alongside Tony, to the two of you, thank you. Coming up, morning calls, and later, Walmart falling from record highs, delivering a cautious outlook. From the opening bell, let's get you some morning calls. First up, Mizuho upgrading Intel to a buy, expecting shares to benefit as the company launches its new server products. Citi downgrading Plug Power to neutral, saying management's subpar execution has led the company into liquidity challenges. And finally, TD Cowen downgrading Target, expecting stretched consumers to pressure near-term growth. Coming up, Walmart sounding the alarm on the US consumer. That conversation up next with BlackRock's Amanda Lynham. Your opening bell just around the corner. Let's get right to it. 25 seconds away from the opening bow this morning. Good morning to you all. Just a touch of weakness out there in the data, in the commentary around the earnings. Jobless claims a little bit higher than expected. Walmart with a cautious view on the consumer going into year-end. Equity futures pulling back just a touch. We're down about 0.2% on the S&P. There's your opening bow. Switch on the board and get to the bond market. What a few months it's been for 10-year treasuries. A week ago today, in the morning, a week ago Thursday, the 10-year yield opened up at 448. All the volatility in between, and look where we are, 447.26, yield to lower by 6 basis points. The euro showing some strength, bouncing back to 108.64. We're up by 0.15% on that currency pair. Elsewhere, crude pulling back 2.7%, down to $74 and about 60 cents. About 30 seconds into the session, we're pulling back just a touch by 0.1% on the S&P, down by 0.3 on the Nasdaq. One stock to watch all morning, Walmart, the retailer, sounding the alarm on the US consumer after signs of weakness at the end of October. America. Abby has more. Hey, Abby.
Well, this is really an interesting one, John, because we do, of course, have the stock down sharply, down more than 6%, heading to its worst day since July of 2022. And the quarter that they put up was basically in line, and they actually raised the guide just slightly. The increase of 7 to 7.5% in operating income, a little bit little changed, and not quite as much perhaps as some folks had wanted. But it's that color that you were talking about, the idea that at the end of October there was a demand weakness. Now, it did rebound apparently in the beginning of November, but they're talking about that around the holidays. So they're kind of cautious here on the consumer. They're saying specifically that we are more cautious on the consumer than they were just 90 days ago at this time. Also making this super interesting, at least to me, Target said something very similar yesterday, but Target going into their print yesterday, and it was a blowout in terms of adjusted earnings. That's not the case here for Walmart, down 25% on the year. Walmart coming into today up 20%, outperforming the S&P 500. You add on this color that, again, is not all that different than what Target said yesterday about being somewhat cautious about the state of the consumer, having to do with interest rates and student loan repayment. Well, the stock is down 6.6%, John, the worst day since July of 2022.
158 this morning. Abby, thank you. Let's go back to that quote from the Walmart CEO on the earnings call. In the US, we may be managing through a period of deflation in the months to come. That's something we all need to think about in the weeks and months to come, beyond just equities, beyond Walmart, for the broader bond market as well. Let's stick with retail earnings. Very different outcome for Macy's this morning. Topic, profit estimates thanks to improving inventories. Katie Greifeld has this one. Hey, Katie.
Well, Macy's is rallying hard on the heels of that report. You take a look at shares right now, up double digits. After beating on profit, you saw adjusted earnings per share come in at 21 cents. That is well above the average analyst estimate of 0 cents. So again, a beat there. You also saw gross margin come in just above 40% thanks to fewer product promotions. And an interesting wrinkle in this report was the drop that you saw in same store sales, a third straight quarter actually of declines. And if you think back to what we saw from Target yesterday, this is a developing trend among the retailers. Basically, you see improved profitability, but falling comparable sales. Again, saw a similar thing with Target. And it's difficult really for these retailers to maintain that sales growth that they enjoyed during the pandemic. It looks, though, that investors will take the improving profitability, though. Macy's up about 11-12% right now, should be its best day since June.
Katie, thank you. I said this a little bit earlier this morning. It's like the best and worst of it with earnings. You can cherry pick a story, just pick a couple of companies and say whatever you want. Pick on Walmart, Burberry this morning, and talk about a consumer slowdown. Take Macy's, throw in Target yesterday, and you can talk about retailing stocks doing nicely. Let's talk about one that's doing okay. Williams-Sonoma reporting results that surpassed expectations, but cutting its net revenue forecast for the full year. Simone Foxman on top of this one. Hey, Simone.
John, both you and Katie were talking about this same story, slowing sales but higher profitability. That's exactly what we saw at Williams-Sonoma as well. And traders, this was actually initially down immediately post earnings in the pre-market, but now we're a little bit higher. The company cutting its full year revenue forecast, expecting revenue to fall 10 to 12%. It had initially expected this to drop 5 to 10%, but raising its overall guidance for profits on margins, now seeing 16 to 16.5% versus Wall Street's expected 15.3% for the full year to come. In the third quarter, it was already the same story. We saw margins at 17%, a couple points higher than the estimate. And we saw profits beat, but comp sales were down substantially, down 14.6%. Revenue missing estimates down 15% year on year. And this really felt across all of Williams-Sonoma's brands. CEO Laura Alber in the statement talking about an environment filled with ongoing consumer hesitancy on high ticket discretionary furniture spend. Remember, those high interest rates, also elevated levels of promotional activity. We are looking at shares well above 40% up for the year to date. And on the 10 a.m. call, we're going to look at indications of holiday spend, also the impact of higher rates, as well as just broadly a weak home sector, John.
Ismail, thank you. Let's get to a name that's really struggling this morning. Shares of Cisco. Cisco's down about 12.5%, potentially on course for the biggest drop since May of 2022. Forecast out of this company yesterday, raising concerns that corporations are reining in their tech spending. Ed Ludlow has this story. Morning, Ed.
Yeah, good morning, Jonathan. The narrative from Cisco was that this is not some broader economic slowdown in the fiscal first quarter that just happened, or the fiscal second quarter, which for Cisco is the period ending in January. What they said is that sales would be between $12.6 to $12.8 billion in the quarter ending January, but the Street's forecast for that period was $14.2 billion. So this is a pretty big miss in expectation. What they said was that in the last 6 months, they have shipped against a backlog of network gear orders. In other words, some of the biggest enterprise customers finally took delivery of equipment that they've been seeking for quite a long time. As a result of that, Cisco has done well over the next 6 months. But what those companies or enterprise customers will now be doing is installing and utilizing the orders they've already made. There's a difference of opinion between the Street and Chuck Robbins and Cisco CFO as well, which is that the narrative from Cisco was they see sales accelerating again once customers have worked through installing that equipment. The concern, and there is a difference of opinion on the sell side here, is whether this is indicative of a broader down cycle for networking gear. One of those names being Piper Sandler's James Fish, who will be on the show with me later today. But a big drop, as you said, we're down more than 12%, on track for the biggest drop since May of 2022, or in other words, the biggest decline in around 18 months.
Ed, stick with me. Looking forward to the show a little bit later. No doubt you'll be talking about Cisco, maybe even Alibaba. Let's bring that name up. That stock is getting absolutely hammered. It's down about 10%. Ed, I'm sure you've been following this story. Calling off the spin-off of its giant cloud business. Ed, what are your thoughts on this currently?
Yeah, there's a lot that's an analogous between Alibaba and Amazon for obvious reasons, right? It is principally to the outside world an e-commerce platform. What they've been able to do less of is turn the cloud business into the cash cow that Amazon was able to do with AWS. And as you know, they're looking at each individual unit for potential spin-off to isolate it and help it to grow at a faster click. Stalling on those plans, but also the growth narrative around their cloud business seems to be the principal concern this morning, and I think the ADRs are down almost 10%, so that kind of tells you everything.
Down 9.8. Ed, thanks for that. Appreciate the update. About 8 minutes into the session, broader market looks like this, down about 0.1% on the S&P, down 0.25% on the Nasdaq. Joining us now to continue the conversation is BlackRock's Amanda Lynham. Amanda, wonderful to catch up with you. No doubt you've seen it all week. At times, particularly on Tuesday, equity investors buy absolutely everything. Are you seeing the same thing in credit markets?
Good morning, Jonathan. Thank you for having me. We are seeing a trend of compression in the high yield credit markets, meaning that high yield has been outperforming investment grade, which is notable. I mean, we've been tracking high yield spreads, as you know, and they're now notably below 400 basis points. And I would say a decent chunk of the high yield market is actually even much tighter than the index level. Over half of that index is 100 basis points tighter than the index spread. So what does that mean? That means that investors are looking for risk, but there's a limit to their appetite, and triple C's lagging has been a constant theme over the past few weeks, even despite this broader risk on tone. So the capital markets are open. We've definitely seen inflows into the asset class, but triple C's really can't seem to catch a bid. And I think it's really indicative of this challenging position of a subset of the market that has weak fundamentals, but then also near-term refinancing needs. And I think investors are kind of drawing a line into how far down the risk spectrum that they will go, and that's true for both high yield and loans. You're seeing it in the consumer as well. I know you've been focused very much on the retail sales dynamic and the consumer, and even with the consumer, the New York Fed had some really interesting data out recently, which showed that the main pressure point for credit card delinquencies is really lying in that consumer that has both auto loans and student loans. And so similar to the corporate market, where I would say there's generally a feeling of decent health, that's our view on the consumer as well, that the high-end consumer has been doing a lot of the heavy lifting in terms of spending. But when you drill down into the lower income cohorts, specifically those with multiple types of debt, there's really a vulnerability there.
There's a ton to unpack there. Let's just go through it piece by piece. Amanda, when you see high yield outperform IG and within high yield, triple C's lag, do you think that speaks to maybe the temporary nature of this particular rally this week, that within credit there's a belief that perhaps the good times don't last?
I do think actually there can be some stability in high yield spreads if we do manage to pull off a soft landing. I think the scope for material spread compression in high yield is probably limited, but I do think there is a case for stability in high yield. I think what you're pointing to, Jonathan, is really the market's hesitancy with respect to these really low quality firms that have clear refinancing needs, because we just haven't seen that price discovery process in the new issue market for that low end of the credit spectrum. Most of the issuance that we've seen so far this year, it's been light and it's been skewed towards the higher quality, higher rated firms. And so for firms that have refinancing needs, I think the market is just a bit hesitant to see where actually the clearing level is for that refinancing, and is that something that is economically viable for that company. We had the most recent data for defaults from Moody's out overnight, and we're seeing a continued uptick in the default rate in the U.S. corporate market. Again, leverage loans, floating rate borrowers are doing the heavy lifting of that default rate, but it's still climbing. We haven't seen that plateau yet, and I think that's exactly what the market is focused on.
We have visibility on those financing needs. We understand where that maturity wall is. Can you walk us through it? Just where is that window? Where do you think it lands on the calendar into next year?
Sure. So we're really expecting this activity to be window-based and episodic. Really, the maturity wall starts in 2025. It does not let up until 2029. So there's a pretty steep mountain that those firms need to climb. Typically, high-yield companies don't like to let their debt become current or due within 12 months. So it's reasonable to assume that 2024 should be a focus point for these corporates to address those maturities. I think where we would see a pause would be periods of market volatility where corporates just aren't sure that they can execute on a refinancing, or corporates that are trying to be almost maybe strategic about the timing. My view on this, as you know, is that it's better to issue early rather than late. And so I would not be surprised in periods of market stability for corporates to move forward and really start to chip away at those maturity walls, even if they're leaving some basis points on the table, so to speak, in terms of the interest costs.
So, Amanda, the Federal Reserve, Fed officials have come out, Mary Daly in the Financial Times yesterday. They're not ready to declare victory in the fight against inflation. Tony Rodriguez of Nuveen earlier this morning on this programme said no rate cuts until the second half of 2024. I think ultimately, Amanda, we've got no idea where those rate cuts land, but let's just say that's true. Second half of 2024. If the Fed's not cutting rates until then, Amanda, can you describe the kind of problem we might see as some of these companies try and come back to market and issue debt?
Sure. And I thought your conversation with Tony and Mike was great. And I would agree with that. I think the bar for rate cuts in the first half of 2024 seems very high. I've been encouraged by the inflationary progress that we've seen with the CPI data most recently this week. I think it eases the pressure on the Fed to hike from here for sure. But Chair Powell has been very clear that they don't want to be misled by a few good months of data. They don't want to be misled by inflation head fakes. And so I do think that they will hold rates in this restrictive policy area. So what does that mean for corporate credit? For the majority of the investment grade market, it's a headwind, but it's incredibly manageable. I would say that's also true for most of the high yield market. But again, the exception is really in that kind of lower quality cohort. So definitely the triple Cs and even the low single Bs. I do think that it's reasonable to assume that the default rate picks up modestly from these levels. So we're hovering just in the low fives in the U.S. high yield market. There's probably some room to go there, but do we revisit the COVID peaks of 8.5% to 9% default rates? I don't believe we do. I'm not expecting us to come close to the GFC peaks of 14%. So a modest uptick in the default rate is what we should expect. And then ongoing dispersion across sectors, within sectors. That's been a key theme of the high yield market. We've seen more dispersion in the high yield market relative to its IG peer, which makes sense for exactly the reason that you're noting. So again, I'm still in the camp of this is a catalyst for credit market dispersion as opposed to credit market disruption. But really the key is not just the Fed monetary policy at the front end, which is relevant for floating rate borrowers, but the long end volatility, which I think is also an input to the cost of capital.
Amanda, thank you. Appreciate the update, as always. Amanda Lanham there of BlackRock. About 15 minutes into the session, equities right now basically unchanged on the S&P 500. Coming up, the Senate averting a government shutdown.
I have good news for the American people. This Friday night, there will be no government shutdown.
US lawmakers kicking the can, setting the stage for a busy agenda and spending deadlines in the new year. That conversation up next.
I have good news for the American people. This Friday night, there will be no government shutdown. Thank you. Because of bipartisan cooperation, we are keeping the government open without any poison pills or harmful cuts to vital programs. A great outcome for the American people.
Was it Jeb Bush who once said, please clap? That's what that reminded me of. Majority Leader Chuck Schumer declaring a victory of sorts. The Senate voting to pass a temporary stopgap bill, averting a government shutdown for now. Once President Biden signs the bill, 2 new deadlines loom in early 24. Not everyone is declaring victory. GOP hardliners pushing back against House Speaker Mike Johnson's compromise with Democrats.
One thing. I want my Republican colleagues to give me one thing, one, that I can go campaign on and say we did. One. Anybody sitting in the complex, if you want to come down to the floor and come explain to me one material, meaningful, significant thing the Republican majority has done besides, well, I guess it's not as bad as the Democrats.
Team coverage starts right now. Bloomberg's Kelly Lyons in D.C., AMH in San Francisco. Kaylee, a big fight on the horizon.
Yeah, lawmakers may be able to enjoy their holidays. Everyone's already left for Thanksgiving, in fact, John. But come the new year, it is going to be a reckoning. As you said, there's 2 dates we're dealing with. Funding extended partially to January 19th when it comes to ag, energy, veterans affairs, transportation, and February 2nd for everything else, including defense. The problem is to meet those deadlines, there's going to be more limited options. Speaker Mike Johnson has already said he will not support another stopgap continuing resolution like the one just passed. And it does seem like hardline conservatives in the House are going to hold him to that. That really leaves 2 options. Option 1 being finish the work of passing all of the different appropriations bills. Option 2 being shut down the parts of the government that's funding is running out at those dates. Option 1 obviously is the preference, but it is going to be very hard to accomplish. As we just heard from Congressman Chip Roy, Republicans really want to see deep spending cuts. At least hardline conservatives would like to see spending cuts that go even beyond the debt ceiling deal that was reached between former Speaker Kevin McCarthy and the White House earlier this year. The problem is deep cuts are not going to fly in a Democratic-controlled Senate and would not be signed into law by President Biden. So trying to reconcile these different priorities is going to be very difficult, especially for Mike Johnson, who already is facing some ire from conservative members of his party and is operating under the same rules that Kevin McCarthy was under, which is one member could bring forward a motion to oust him from the speakership. So come January, John, it's not just going to be a question of will the government stay open. It's also going to be a question of will Mike Johnson keep the speaker's gavel?
AMH, this is going to be so difficult. Run through it. Katie just went through the spending difficulties, the personnel, the people involved. Then you've got aid to Israel, aid to Ukraine. Anne-Marie, that's tough.
It's going to be challenging, Jonathan, when you look at what the president is requesting from Congress when it comes to the national security priorities he outlined. It was aid to Israel, aid to Ukraine, aid to Taiwan, as well as more aid to the U.S. southern border. The issue is, altogether, this is going to be a difficult package for Republicans to sign up on, and even potentially some Democrats. But if you were to take them and sever each individual one, there could be bipartisan support. The problem is, Jonathan, of course, is you have a House that passed an Israel bill that had a pay for that a Democratic Senate will not sign off on. So you talk to people and they say there is a path for this to get done. But as Kaylee outlined, we just saw Congress this week do the bare minimum, keep the government open. And we're going into the holiday season, and they're going to be up against another deadline of this sort come January.
Can't wait. I know you're both excited. Anne-Marie, Kelly Lyons, thank you for the coverage. Appreciate it, as always. About 23 minutes into the session, equities just about positive with some sector price action. Here's Abby.
It may be a small gain right now for the S&P 500, John, but it is a broad gain. The composition sector-wise, most S&P 500 sectors are higher, 8 to be exact, led by utilities up 0.5%. The dividends of those companies look more attractive with yields down today. Tech also though, up about the same amount to the downside. Energy falling in sympathy with oil, which is down right now by about 2.5%. If we take a look at what is happening for China Tech and also the NYSE FANG index, we've got some weakness. The China Tech index is down 2.4%. The NYSE FANG index off of its lows, but nonetheless down. And Alibaba, the worst day since October, as you were talking about earlier, after nixing that cloud spinoff.
A tough day for that stock, that's for sure. Abby, thanks for the update. Appreciate it. Up next on the programme, we'll take another look at the calendar going into the weekend. 26 minutes into the session, equities doing okay, positive by 0.2% on the S&P. Let's get you the schedule going into the weekend. It looks a little something like this. President Biden speaking at 1:45 p.m. Eastern Time from the APEC Summit. More retail earnings with the Gap reporting after the closing bell. On to Friday, Fed speak from Collins, Barr, Daly and Goolsby. And we finish up with some U.S. housing starting data coming up at 8:30 Eastern Time tomorrow. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.